Most people think the first $100,000 is simply a milestone, a symbolic checkpoint that appears on a savings account statement and signals that someone is finally becoming financially responsible. In reality, something far more structural happens around this number. The behavior of money itself begins to change. The pace of growth begins to shift. And perhaps most importantly, the psychological relationship between a person and their finances quietly transforms in ways that are difficult to notice while they are happening. Imagine two individuals standing at very different starting points. The first person has managed to accumulate $5,000 in savings. The second person has already reached $100,000. Both individuals continue working, earning income, and adding small amounts to their savings each month. On the surface, their behavior may look similar. They both save, they both invest cautiously, and they both try to manage their expenses. Yet the outcomes over the next decade will likely diverge dramatically, not because one person works harder or makes smarter decisions, but because the underlying mathematics of money begins to behave differently once a certain threshold has been crossed. To understand why this happens, it helps to think about money not as a static object, but as a system that interacts with time. Small amounts of money grow primarily through contribution. Larger amounts of money grow primarily through compounding. At very low balances, growth depends almost entirely on new deposits. If someone saves $500 per month with only a few $1,000s invested, most of the growth in that account is coming from the act of saving itself rather than from the returns generated by the capital. The portfolio is still in what might be called the accumulation by effort phase, but as the balance increases, the internal engine of the portfolio begins to play a larger role. When an account approaches $100,000, even modest investment returns begin producing noticeable changes. A 5% annual return on $5,000 generates $250 over a year, which is hardly noticeable compared to the monthly deposits being added. However, the same 5% return on $100,000 generates $5,000 over the same period, an amount that begins to resemble a secondary income stream rather than a rounding error. This shift may appear subtle, yet it marks a transition between two very different financial dynamics. Below this level, progress feels slow because effort dominates growth. Above it, the mathematics of compounding begins sharing the workload. The saver is no longer pushing the entire system forward alone. The accumulated capital starts contributing meaningful momentum of its own. Historical financial data shows this transition clearly when long-term investment curves are examined. During the early years of saving, the graph rises gradually, often frustratingly slowly, because each contribution adds only a small increase to the total. Eventually, however, the slope begins to steepen. The curve becomes smoother and more responsive to market returns. While the exact point varies depending on contribution size, interest rates, and investment behavior, the region around $100,000 frequently marks the moment where the balance becomes large enough for compounding to visibly accelerate the trajectory. Yet the mathematics tells only part of the story. The psychological dimension is equally important. For many individuals, the journey to the first significant six-figure balance requires years of disciplined behavior. Budgeting becomes routine. Spending choices are evaluated differently. Impulsive purchases slowly lose their appeal when they represent meaningful percentages of savings progress. Over time, these habits build a mental framework where money is no longer seen solely as something to spend, but also as something that can quietly generate stability. When the account eventually crosses that six-figure mark, the psychological feedback loop begins to strengthen. Seeing investment returns that equal or exceed several months of personal contributions can alter how someone perceives time, risk, and patience. The saver starts recognizing that financial growth is no longer entirely tied to working more hours or increasing income. Instead, time itself becomes a productive partner. Behavioral economists often describe this shift as a change in financial identity. Early in the process, individuals feel like they are struggling to build savings against constant friction from expenses and unexpected costs. Once a meaningful balance exists, the narrative slowly evolves. The person begins to see themselves not just as someone earning money, but as someone managing capital. This subtle identity shift influences decisions in ways that compound over years. Investment discipline tends to improve, unnecessary risks appear less attractive, and long-term planning becomes easier to sustain. There is also a structural reason this threshold matters in the broader financial system. Access to certain opportunities often expands as balances grow. Lower investment fees, more diversified portfolios, and the ability to absorb temporary market fluctuations all become easier when savings reach a scale that can tolerate volatility. A 5% market decline on $5,000 may feel insignificant numerically, but emotionally it can discourage new investors from continuing. The same percentage decline on a larger portfolio is often easier to interpret as a temporary fluctuation within a longer compounding process. From a systems perspective, the $100,000 mark functions less like a finish line and more like an ignition point. Before reaching it, the saver must rely heavily on discipline and consistent contributions to move forward. After crossing it, the internal mechanics of the portfolio begin to participate more actively in the growth process. The balance starts responding more strongly to market returns, which means time becomes increasingly valuable. Interestingly, this threshold appears repeatedly in discussions among investors, economists, and financial historians, not because it holds mystical significance, but because it represents a practical intersection of psychology and mathematics. It is large enough for compounding to become visible, yet still within reach for individuals who practice steady saving over many years. The combination of these two factors makes it a powerful turning point in how money behaves. Of course, reaching this point does not eliminate financial challenges. Markets fluctuate, economic conditions change, and personal circumstances evolve. The presence of a six-figure balance does not guarantee future wealth or permanent stability. What it does provide is a shift in the underlying mechanics of growth. The saver is no longer operating entirely in the effort-driven phase of wealth building. Capital itself begins to share responsibility for progress. Understanding this transition can change how the early stages of saving are perceived. The slow progress that characterizes the first years is not evidence that the system is failing. It is simply the nature of a process that requires a certain amount of stored momentum before it begins accelerating. Much like pushing a heavy object across a flat surface, the initial effort feels disproportionate compared to the visible movement. Once the object starts rolling, however, maintaining motion requires far less force. In financial terms, the first $100,000 represents that initial push. It is a period where habits are built, patience is tested, and the foundations of compounding are quietly assembled. When the threshold is finally crossed, the system begins to move differently. Not instantly, not dramatically, but steadily and measurably over time. And in the quiet mathematics of long-term finance, that shift in behavior is often the moment when money truly begins working alongside the person who earned it.